Good afternoon. It's Patrick Armstrong. I'm Chief Investment Officer at Plurimi Wealth, and it's the 22nd of February, 2023. Today I'm going to talk a little bit about the economy and what I've seen, and I think what the market's seen this year is the economy has proved to be incredibly resilient. The green line on this slide here is called the Citigroup Economic Surprise Index, and it just measures a bunch of economic data as it comes out, and it compares that to what the consensus expectations are. And overwhelmingly, recent data has beaten expectations. Doesn't necessarily mean data has been strong, but it has beaten expectations. And what you've seen is 6-month yields, 3-year yields, 10-year yields, they've all been moving higher as the market's starting to discount an economic situation which is not certain everything's falling into a recession anymore. And I think the yield curve at the beginning of the year was very inverted. It's still quite inverted, but you've seen the cuts that the market was pricing in the second half of 2023 for the Fed. Those are looking less likely in our opinion. And for me, what this means is we're in a situation where the market's going to reward cash flows and it's going to reward cash that's coming today versus cash that's going to come in the future. So positioning in shorter duration assets in terms of fixed income, I think you're going to get rewarded. The shape of the yield curve gives you 5.5% if you buy a 3-month treasury, whereas it gives you 4% if you buy a 10-year treasury. So the inversion of the yield curve is not what I expect will be rewarded, because we're in an environment where if the recession doesn't come, the 10-year yields are going to have to drift higher. The Fed isn't going to have to cut. So I really think fixed income positioning should be shifted towards the front end of the curve where you're getting a higher yield, less volatility. And also on equities, I think very similarly, duration will be punished. In January, you've seen companies that produce no earnings be the best performers. The no earnings technology index from Goldman Sachs is up 35% year to date. Stock market as a whole is up about 6% year to date. So very strong gains everywhere. But the longest duration assets went up the most, and that was based on hopes the Fed would be cutting. As those hopes get removed, those assets are going to be at risk, in my opinion. And the main thing that's keeping me quite confident that we're not in the midst of falling into a recession is the employment situation in the United States. Unemployment's at a 50-year low right now in the United States, 3.4%. 1968's the lowest it ever got to, where it fell just below 3.4%. And the NFIB survey of 2,000 companies in America, 45% of those companies are saying they're having a hard time filling their job openings. And again, that's very near a 50-year high on that metric as well. The US economy is 70% consumption. A fully employed consumer in the United States spends their money. And I think until you see something that disrupts that employment, it's going to be hard to bet on a recession. So I think shifting short duration in fixed income and in equities is the best way to position in this environment.